All right, let's talk about the mystery charts and the methodology in action. Here's a follow-up on our mystery chart, which is also a good psychology lesson too. I noticed that the Landry light down below was all green, and then occasionally it would come down and to zero whenever the price comes down to the moving average. This, in case you're new to me or my methodology, this just counts the number of bars that the stock or crypto or whatever you're looking at, index, ETF, is above the moving average. It could be any moving average you want. I like the 30 EMA a lot. I used to be a huge fan of the 20 EMA, still am, I guess. But now the 30 seems to really be a great moving average to pay attention to. But anyway, Landry light pullback, you're just looking for 10 bars or so above that 30 EMA. Ideally, you want some acceleration and persistency, and we have both of those here. And then you're looking for a pullback to the moving average. This is a fairly clean setup for a gold stock, and I like setups to be as clean as possible. Obviously, with the gold stocks, I tend to be a little bit more lenient. But anyway, pulls back to the moving average. And notice down below, we go from a Landry light count of 11 or so down to 0, because when you touch a moving average, it resets. And this was the recommendation in my service entry of 2150, protective stop of 1875, IPT, which is initial profit target of 24.25, and that's $2.75 risk on this particular trade. Entries here, stop is here, initial profit target is up here. And you can see it triggered an entry. It did okay for a couple days, but unfortunately came back in. But fortunately, took off again. My youngest daughter, when she was, I guess, elementary school, they were teaching her, fortunately, unfortunately, and my wife and I were always saying that to each other. Fortunately, whatever happened, unfortunately, this happened. So this is unfortunately, but it ended okay, fortunately. Well, I guess it's not completely over yet, so we'll find out. Anyway, there's my trades down below. I had taken profits slightly early on this one. And also because the entry, it triggered about 10 cents above where my initial entry was. The initial entry was 2150. The entry that I ended up with, because of the gap and all, was 2160. So a little bit less than $900 in the model account. I did take this across multiple accounts, and I did exit slightly early, but I did put out a warning first that, hey, start thinking about exiting. And then the other thing that I had a little messed up was in my service, I had fat fingered it. I put the IPT at 24.75. It's supposed to be 24.25 because my equity in my model account was approaching 2,000, which is, we're looking for a 2,000 total gain, which would be 2% of the overall count, and then we take off half of that. And I think I have a spreadsheet in here in a minute. I'll walk you through a little bit of that in a second. But anyway, stop comes up to break even on the remainder, barring overnight gaps. The worst you could do is break even on that. I have a guy in the group that's doing a lot of research, and he's putting his money where his mouth is. He thinks that you're better off hanging on to the whole position. And I think if you're in a rip-roaring bull market, yeah, but I've seen way too many stocks come right back in after hitting that initial profit target. So and psychologically, people have asked me before, is your money management psychological, statistical? And my answer is yes. I think psychologically, not to get all freshman psychology on you, but above Wi-Fi and food and shelter, as far as things you need to live, it's a self-actualization, self-fulfilling, self-realization, self-actualization, et cetera, higher up. I think that lower down, you have those more intermediate term needs, and I think that taking the partial profits sort of fulfills that. And it also, instead of watching $2,000 completely evaporate and possibly even turn to a loss on a gap overnight, why not take half of that money, put $1,000 in your pocket, and barring overnight gaps, if you scratch out, at least you got $1,000, and multiply that by the size of your account, obviously, 2,000 per 100. Anyway, here's KGC. It was in a longer term uptrend. It did accelerate higher, and then it kind of flattened out a little bit, but then it tried to break out and came back in. That's okay. That's a pattern I call a double top knockout. And once again, we come down to the 30 EMA. as I often preach, and I also preached in that article yet again, basically the article was on me preaching, and so I did a lot more preaching. And it's a worthy read if I say so myself. You can find it on Substack. You can also find it on my website, davelandry.com. But anyway, the point is to keep it simple, and all you need is one pattern to be successful. And I'm shocked. I mean, that TFPM was a Landry-like pullback. This is a Landry-like pullback. It hasn't worked out swimmingly just yet. We are profitable. I'm up about $1,000. No, actually $700 now in the model account, which is better than poking the eye so far, at least knock on wood. But anyway, I'm amazed at how this one simple pattern, and I remember a while back, I know I've said this ad nauseum, but a while back I was in a webinar, and I went in and looked at all the recent trades, and we were on a pretty good run at that particular point in time. And all of the trades were Landry-like pullbacks, and I was kind of shocked. There were other patterns too, but they were all also Landry-like pullbacks. Like this one is what I call a double top knockout. We have a minor double top where it looks like the stock could be in trouble. You get the knockout move, and then of course it's backed by a longer term trend. Then if the market begins to resume its uptrend, a lot of players, a lot of shorts get sucked in, and a lot of people get squeezed out along the way. Anyway, down here you can see DTKO, double top knockout, pullback. It's also, again, a Landry-like pullback. So that could be your only pattern, even though it's other patterns in this case too, which is even better. Anyway, entry here, stop here, initial profit target here. Let's take a look at what happened. It comes up, it triggers, didn't do a whole lot, and it's kind of meandering around. And it's right about there now, maybe a little bit less. And in a case like this, I'm not showing in this slide, but we would bump the stop up a little bit. So a lot of people say, Dave, do you wait until you hit the initial profit target to bring your stop up on the remainder? And the answer is no. If that happens intraday, then obviously you do it. But if the stock moves a little in your favor, it's kind of almost a one-for-one relationship with that stop on the entire position, okay, the full loaf, so to speak. And if it's only up a few cents here and there, I don't really bother adjusting it. And I also, in more recent years, have loosened it up a little bit in the process. So if it goes up 25 cents, maybe I'll bring the stop up 15 cents or whatever. Now, once I hit the IPT and I'm free rolling, so to speak, playing with the market's money, so to speak. Did I just make air quotes? I hate people make air quotes. Little buddy foo-foo. Anyway, once you're in a position like that, it's a good position to be in. And then you can allow that stop to gradually open up over time. Now, you never move the stop away from the stock. You move the stop up as the stock goes higher, or crypto, whatever market you're trading. And you do that two ways. Let me just get it out real quick since it's in my head. Gaining ground would be one way. Let's say you're blessed with a stock that goes up 3 points. Then you might only move your stop, STOP, up 2 points. So you've gained ground, you've gained 2. So you're going to make 2 more points if you get stopped out. But what you've done in the process is you let that stop widen out 1 point. So as the stock gets higher in price, the point movement is going to increase, okay? So letting that stop widen out, you're adjusting to the higher price in the stock, okay? Also, if you do this right, you're going to get an expansion in volatility, so that volatility is going to increase. And then by letting that stop loosen in a second loaf, of course, you're adjusting to that longer term volatility. The other thing is you're putting yourself into more and more of a position of a longer term trader. Like I said a second ago, client, he's experimenting with the full loaf and everything. Well, the reality of that is you probably need to use a smaller position size and a much wider stop. So the point I'm trying to get to there is, let's say you want to hold the position for, let's just pull something out of the air, 2 days. Well, the volatility on 2 days is about that big, okay? Let's say you could withstand about a 2-day move, and my goal is to withstand a swing trade move of a week or so to try to see if we can get that swing trade profit out before letting that stop loosen on the remainder. But if I was to go in and say, okay, I want to hold this stock for 6 months, my stop needs to be really wide, okay? So that means I'm going to have to trade fewer and fewer shares. So for me, this is kind of like a Goldilocks thing, the taking partial profits, using the 2%, and the widening of the stop and the remainder of it. It just works for me. Now, as you'll see in 1 second, from a psychological standpoint, there's a lot to do with trading that fits your own psyche, okay? And I could give you the greatest system in the world, and if you didn't have the guts to follow it, or the confidence to follow it, or the discipline, however you want to look at it, then you'd be in a lot of trouble because you couldn't follow the system. And the example I've given before is I was on a traders panel once, and one of the guys there said that he had a system that worked, but he just couldn't follow it. It didn't really fit his psyche. And he actually hired someone to follow it. And the rules for the employment were really, really simple. Follow the system. That's pretty much it. And rule number 2 was, if you don't follow the system, you're fired. And he says, son of a bitch, the guy followed the system. But anyway, so this is KJC, slightly profitable, or nicely profitable. So we will move that stop up a little bit on that. Now, just a quick example. I like to throw a few things out, live examples here and there of things you need to be cognizant of. And one of them would be wait for entries. Okay, so make sure you're cognizant of that. And this was the stock in a decent uptrend. And I actually felt like it could use slightly more pullback. I know it's kind of crazy, but it's a super volatile stock. I forget the HV, but it's triple digits. And it was a trend pivot pullback. So I felt like it was a little too risky to show as an official setup for my trading service. So I made it an honorable mention. And then whenever I put out an honorable mention, people immediately email me, Dave, give me some parameters. So I always put the parameters in there in case anybody wants to take anyone wants to take a more volatile type of trade, a more speculative type of trade, or something that might not be set up perfectly. Anyway, there's all the parameters, and the main thing to watch is the entry was 450. Entry was there, stop was down here, and IPT was up there. Now, percentage-wise, this stop is huge, just FYI, but notice how much this stock moves around. This is like a 300 to 400% move over a fairly short period of time. So when you look at the chart, the stop's only that far away, but in reality, it's like a 30% stop. And, people told me before, Dave, I can't trade no 30% stop. I was like, well, you don't get no Coke. That's what the market calls for. You adjust your share size accordingly. So you don't come in here and trade 10,000 shares on a 100K account. I think it was 1,300 shares or something was a share size based on 2% risk. Anyway, long story endless, the point I'm trying to get to is that this stock failed miserably, as you can see, but no capital was put into harm's way. And as I said 10,000 times, and even in the aforementioned article, I'll get emails from people all the time. 6 months from now, I'm going to get email on this one. Hey, Dave, what should I do with that trade you recommended? I'm down 90%. I was like, I never recommended that. It's going straight down. Why would I recommend that? Yes, you did way back in June. I'm like, okay, well, let me go take a look at that. It's like, oh, yeah, I recommended it in May, but looks like it never triggered an entry. Anyway, any questions on all that? Let's keep moving then. Welcome my YouTube brethren. All right, where are we now with the TFM 10% system? I'm not going to go through all the rules there right there for you. I've kind of beat the dead horse on this. I will say for a buy, you need 2 bars of Landry light, 2 lows above the 50 simple moving average. That's a weekly moving average. It's a weekly chart. Now, as I said in last presentation, which was a couple of weeks ago, I don't like buying with this system when it's in a down week like that. Now, I haven't done all the testing and how much opportunity cost you would give up by not buying it then, but I would be willing to bet, and from a little bit of empirical research, there would be quite a few times where you would get whipsawed out by buying on that down move. As you know, with the swing to intermediate term trading, with my methodology, for the core methodology at least, I'm buying things that are going up when they're going up. So I put in a stop entry order. And by the way, I'm shocked at how many times that has kept me out of trouble, these stop entry orders. as opposed to just getting excited about a position and jumping in willy-nilly. So I do like to buy on strength. So now, if we can kind of hang around these levels between now and tomorrow, or even now, I think it would be good. It would be from a system standpoint. I'm not personally buying at this time. I did buy some Qs a while back and wrote it out. But if you were kind of looking at this system as to whether or not it's a legitimate buy or not, now that we're taking out this prior little high in here, and ideally, if you wanted to get a little bit more precise, maybe if we close above that high on Friday, that would be worthwhile. But it is kind of interesting. All right, Landry 100, proof of concept. It's just a bunch of stocks. It's 100 stocks that I buy or I put in the portfolio when they're making brand new 52-week highs. Now, occasionally what I'll do is if the market conditions aren't fantastic, I will go a little bit further down from 52-week highs. But for now, it seems like 52-week highs seems to work. But I seem to remember years ago when I first did this, and I quit in between, as I said before. But when I first did it, I remember the conditions got crappy soon after I started this list, and then I found myself down to like 90-day highs. Anyway, the good news is speculation is still alive, and well, all of these stocks are bought at brand new highs. This one is up 200%. The buy was there, and you can see it kind of failed miserably initially, but then it eventually took off. So not a perfect example of a stock just making new highs and keep on making new highs, but you can see that buying new highs in general is a conceptually correct way to approach markets. The big caveat is that this portfolio, which is hypothetical, is 100 stocks. So you're going to occasionally capture the 200, the 300, and even the 1,000% move in these stocks if you have a portfolio of them. So getting back to the proof of concept, and I'm just kind of thinking out loud here, but one of the things with a methodology, and I've been chastised for saying this in presentations, but it's true. It can be a little elusive because you're depending on that occasional outlier to make your year, and it doesn't happen that often. But every now and then we'll get in one and ride it for a few years, and it'll go up 300 or 400 and even 500%. That makes a huge difference in the overall portfolio. So this is a hypothetical $1 million portfolio. So this one position here is now worth 10% of the entire portfolio. So that makes a huge difference. And a big winner or two every now and then will cover a multitude of sins. I've often said that money management will cure multitudes of sins, but a big gainer also will help you out tremendously. So that was the first 1,000% gainer. I don't use any money management in this. I think if this became a real portfolio someday, then yeah, I probably should use some money management. Maybe at the least sell each one at a 100% gain, half of it at least, and then keep the remainder. But I was thinking about, as I was getting ready this morning for the presentation, if you're up 1,000%, as I just said, that's 10% of your entire portfolio in one stock, and it's supposed to be only 1%, right? Because you're putting 1% in each stock. 100 stocks, 1% each, 10 grand, $1 million, 10 grand in each stock. Now it's worth 10 times that amount. So I think you'd be foolish not to rebalance a little bit. Now there's a fine line between rebalancing and giving up your huge winning position and continuing throwing caution to the wind and letting all that evaporate. This stock has gotten whacked a little bit since then, since I took this snapshot. The snapshot was in my put in my Facebook group a few days ago. Anyway, so the point is some money management would be needed. And again, not to beat the dead horse because I say this every weekend, but as a private trader, I wouldn't rush out and just buy new highs, okay? Unless you're trading like a buy at B pattern and IPOs, or as I'll show you in 1 second, brand new highs or breakouts in crypto. In general, I'm not a breakout trader. I'm more of a pullback trader. Everybody here who knows me today is like, geez, Dave, why do you say the same thing over and over? It's like, well, I'm trying to avoid follow-up questions, so I'll try to explain everything in every presentation. But anyway, you can see how this works. Another cool thing about it is you can see where all the momentum is stacking up. So you can see I have a ton of gold stocks in here, and if you also notice these industrial stocks, quite a few of these are metals and silver. TFPM I think is gold, but it might be some silver too. We're along that one. That's the one we just talked about a minute ago. Anyway, that's kind of cool. And there's also some physical gold ETFs that's not listed as being golds that are further down this list, but also in the list. So this is kind of cool. You can see where the setups are stacking up. I don't see any in here now, but not too long ago, there were grocery stores and maybe a few major drugs. Probably not a whole lot because the major drugs did poorly during the last downturn with most everything else. But the point I'm making there is those were stocks that are defensive in nature because people need drugs and groceries in a bear market. And some people need more drugs. There it is. Notice I zoomed those in. You can see those are the gains in those gold stocks. And what's kind of interesting, and I think I just said this, but what's interesting is quite a few of these got knocked out of the portfolio recently. So it would have been even more stocks. And one thing I'm not really paying attention to, and if this was real money again, maybe I'd have to. But I wanted to take advantage of the momentum as much as possible. So if the gold stocks are running, I'm just going to keep putting golds in here to fill slots if that's what's coming up, right? And I'm not really worried about how many gold stocks end up in the portfolio. If you were doing this on your own or with real money as an institution, you probably would say, well, we've got 10% of the portfolio in gold. It's probably enough. So maybe 10 stocks max or something. Anyway, just some fodder for research there. As I say quite often, the momentum does end badly in a bear market, which we're no longer in, I suppose. The relative strength trading, they'll eventually find you. So some of those grocery stores begin to tank, for instance. And it's a great way, again, to see the money flow. Cash is not trash, and it's treated as an asset class. So I know I've just kind of blazed through that, but we talked about that quite often. And that's kind of one of the cool things about it is you'll just start getting slots of cash if you can't find setups. Okay, so it might be 99, and then before you know it, I think I was down to about 80 or so stocks. So there were 20 slots, so to speak, open. So it's okay if you can't fill the whole thing. And it's a great exercise, if I say so myself. A lot of my big winning trades come out that list. You saw that TFPM was in there. That was a recent one. KGS is in there. That's in the portfolio now. So it's a good exercise, if I say so myself. All right, let's shift gears and talk about mine, the trade.